All right, is buy-to-let investing dead in 2026? Well, yes and no, and I'm gonna explain why. Long gone are the days where you can just buy any property on any street and make a fortune doing so. The amateur investor who's buying the flat down the road and trying to do the refurb themselves, picking their own tenant, putting it in their own name, that version of buy-to-let investing will not help you succeed in your investment journey. And I'll explain why. Section 24 has taken away the tax breaks, higher interest rates have eaten up at the profits, and the Renters' Right Act has made evictions a 12-month court process. However, if you go about your investments strategically, then this market, the market that we're in right now, is actually the best that I've seen since I started doing this out. Think about it. There's less competition, more supply of properties on the market, less demand from buyers, better deals to be had, and more motivated sellers. So in this video, I'm going to cover why the old school way of investing will not help you build financial independence, and how you can navigate the current market to do exactly that. Get this right and 2026 could be the best opening that you've seen in over a decade, and get this wrong, then you might just be opening a huge can of worms. For those who don't know me, my name's Sammy. I'm the director here at Vest in Property, and I've spent the last 4 years helping busy professionals build successful property portfolios. And I've just started this YouTube account, and I'm going to share all my secrets here, so make sure that you subscribe. All right, let's get straight into it. Let me start by giving the doomers and the gloomers their moment, right? There's 3 main things that have changed in the last few years that we need to talk about that's made buy-to-let investing a bit more difficult. And we need to talk about these things because if we don't know what has changed, we won't be able to see what hasn't changed. So the first one that I want to speak about is Section 24. So currently, if you own a property in your own name and you're a higher rate taxpayer, let's say you make around £50,000 each year, HMRC is not going to let you deduct your mortgage payments as a tax deductible expense. So you actually end up paying tax on money that you haven't made. So let's see what that looks like, right? You have a property and you rent it out for £1,000 a month, and your mortgage payments are £500 a month. And then you've got some other costs on there as well, so a lettings and management fee, some insurance, and a little bit for maintenance. Let's say all 3 of these come to £200 a month. So you'd think that, okay, you're bringing in £1,000 a month, and then your mortgage is £500, so you're left with £500. Take away £200, you're left with £300 a month in profit. Fantastic, right? You'd think that you'd be able to pay tax on just the £300. No. If you're a high rate taxpayer and you own the property in your personal name, you have to pay tax as if you made £800, even though you only made £300, because you can't deduct that £500 mortgage payment as a tax deductible expense. Do you see how that can completely destroy a deal that looks good on paper? But don't worry, we've got a fix for this and we'll get into it. Okay, the second reason why it's become more difficult to invest in property is higher interest rates. So between 2009 and 2021, mortgages were running around 2%, sometimes lower. So it's pretty much free to borrow money, and anyone could buy anywhere. Rents, no matter whether you're at market rent or below market rent, you were making profit every single month. That era is over. Today's interest rates are between 5 to 6%, and that has killed off investing in loads of locations where the rental yield is not high enough. So places like London and the Southeast, anywhere where the yield is between 2 and 4%, the math just doesn't work, right? The rent doesn't cover the mortgage, so you're losing money from day one. If you're buying a property where you live because it feels familiar and you live in a low rental yield area, that version of buy-to-let is completely dead. It's not going to serve you. You're going to have to pay out of your own pocket every single month to hold on to that property. Okay, the third reason that buy-to-let property investing has become more difficult is the recent changes with the Renters' Right Act. So the 2 main changes that you need to know about is the abolishment of fixed-term contracts between tenants and landlords. So all contracts now, all tenancy agreements are monthly rolling contract, and the tenant just has to give you 2 months notice to terminate the agreement. The second change is the abolishment of Section 21, no-fault evictions. Now, I actually think this is a good thing, right? I don't think landlords should be able to kick their tenant out without having a reason, but there's no doubt that this has made it more difficult for landlords that have bad tenants to get them tenants out, because Section 21 was always the easiest ways to evict a tenant. As long as you'd done your gas safety certificates, you were pretty much guaranteed to get your property vacated. Okay, so now the difficult thing about this is that actually if you want to vacate your property, it is a bigger, longer, more expensive process. So you have to go through the court, you have to use possessions grounds, you have to use Section 8. So it is more tedious to get tenants out. Now, this one, to be completely honest with you, affects sloppy landlords, people that are not doing the checks on the tenants and not referencing them, people that are just putting anyone in there. Professional investors, people that know what they're doing, people that are using letting agents who do the referencing for them, you'll be all right. But it is worth noting. Okay, so they're the three things that have changed recently that has made buy-to-let investing less attractive. Now, this is the lens that I want you to see this through. When everybody is greedy, that's when you should be fearful. And when everybody is fearful, that is when you should be greedy. That quote actually comes from the legendary investor Warren Buffett, who arguably is the best investor of all time. Right now in the UK, there is a lot of fear. There's a lot of stuff going on in the news. There's a lot of people uncertain about whether to buy or not, people holding off. And let's look at what this actually looks like on the ground. Demand from buyers has gone down, so there's fewer people looking at properties. Supply has gone up. There's more old school landlords who don't want to learn the changes and don't want to deal with the headache and can't bear the higher interest rates. Then people have decided to sell, so there's more motivated vendors. So now we have access to better deals in better locations, and we're able to negotiate harder on these deals. Remember, change equals opportunity. You can either complain about a lack of resources, or you can start getting resourceful. Okay, let's say that you do want to get resourceful and you do want to take advantage of the opportunity. How can you navigate the current market to build a portfolio successfully? The first one that I want to talk about, the first advice that I would give you is structure. You want to sit down with a tax advisor and decide from the get-go, before you've opened Rightmove and Zoopla, you want to look, okay, what is the most tax efficient way for me to structure my portfolio? It is a case-by-case situation. There's no blanket rule here. You need to get professional advice from someone who is qualified to give that advice. And most likely, that is not your uncle who started investing in the 1980s. Okay, so book in that meeting, make sure that you get it right from the very start, because it can be quite costly to change and rectify these issues. You know, if you buy it in your personal name and you want to put it in a limited company later on, you have to pay stamp duty again. You might have to pay some capital gains if you made a profit on the purchase price. So bear in mind that these are things that you want to get done early and get done correctly. Okay, you might think that you're now ready to start opening up Rightmove and Zoopla. Not just yet. So now that you've structured your portfolio, you need to pick an area and a criteria that will exceed the national average. I'm going to make separate videos on both of these, so make sure that you subscribe to get my criteria and my investment area, but I'll just go through it very quickly just so you have an idea. So for the location, you want to look at an area that has high rental yield, high rental demand, and high capital growth prospects. For me, that's Leeds. You want to invest in major cities. I think Leeds is the most undervalued city right now, but again, I'll make a video on that later on. To determine the rental yield, you can look at comparables that have sold in that area and how much like-for-like properties are renting for. And for the capital growth prospect, you need to look at the regeneration and the local infrastructure that's the plan for the next 5 to 10 to 20 years, right? You want to exceed the national average, so you need to be investing around regeneration projects. And for the let rate, you need to go onto Rightmove and Zoopla and search in that area for properties to let, and then toggle on the let agreed button and see how much of them have had a let agreed compared to how many are on the market. That will help you determine what the rental demand is like in that area. In terms of criteria, I only buy properties that range between £100,000 and £180,000. That's the sweet spot. Anything above that, I'd rather buy 2 properties. And anything below that, you're looking at the most rubbish streets in Leeds. And the reason why they're so rubbish and cheap is because they've not had any growth, right? So I like that sweet spot. Between £100,000 and £160,000 is the perfect price to pay for a property. In terms of criteria, I buy 2, 3, or 4 bedroom freehold properties. I don't touch leaseholds. I will never buy a flat. I don't like the fact that I have to pay a service charge and the block managing agent can increase that charge to whatever they want and there's nothing I can do about it, right? I want to control the whole process. I want to control the builders that go in there, the builders that do the work. I want to be able to vet them. That's how I like to structure my portfolios. You need to come up with a criteria. You need to come up with an investment area. What is a good deal if you don't have a criteria, right? You're not going to be able to find or even start looking for a good deal if you don't know what the criteria for a good deal is. Now again, I'll make a separate video on this, so make sure you stay tuned. The third thing that you need if you are looking to successfully scale a portfolio in 2026 is the right team. That includes the broker, the solicitor, the advisors, the builders, the letting agent. You know, with the new Renters' Right Act, you need to make sure that you have a great letting agent who not only knows what they're doing from a compliance perspective, but actually has your interests at heart, right? Someone who's going to put a good tenant in that property because they actually want what's best for you, right? Not just a high street agent that's just going to pick the first person to make their life easier. So going back to our initial question, is buy-to-let investing actually dead in 2026? Well, yes. The old school way of doing is completely finished. You know, you can't just buy anything anywhere and hope it works out anymore. It's not going to work. But the professional way of doing things, where you're strategical about your investments, you actually have a criteria and you stick to it. You look at the locations and you do an analysis on the data. That version of buy-to-let still does exist. And if you stay tuned to this video, I'm going to educate you on all these things so that you have the best chance of success in your investments, so that hopefully you can build your financial independence. Now, if you want a company that can help you do this and do it all for you, that's exactly what we do. We do the property sourcing, the refurb management, and the lettings and management all in one place, all under one roof. If you want to have a conversation about if we're a right fit, it's not a sales call, there's no pressure, no hard sell, just a real conversation to see if we can work together. Link is in the description to my website. You put the details in there and either myself or a member of my team will be in touch. And yeah, look forward to speaking to you guys on the next one.